Hey, everybody. Welcome back to the REI Marketing Secrets Podcast. Today on the show, we have Jeremy Roll. Jeremy started investing in real estate and businesses in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. He is an investor in more than 70 opportunities across more than 1 billion worth of real estate and business assets. As founder and president of Rural Investment Group, Jeremy manages a group of over 1,000 investors who seek passive, managed cash flowing investments in real estate and business. Jeremy, super excited to have you on the show today.
Thanks for having me on, and I appreciate everyone who's listening. Hopefully, this will be helpful for everyone who's with us.
And Jeremy, for our audience out there that's learning about yourself for the first time, can you go back to yourself back in 2002? Why did you decide, hey, I want to start investing in real estate and businesses? What led you down that path?
Sure, yeah. So, boy, that goes back a ways now. For those of you who are old enough, after the dot-com crash in 2001, I was just really sick and tired of the stock market for two reasons. One was the lack of, or so the volatility. So, I didn't like watching my portfolio go up or down 30% in a year. It just was not the right fit for me. I'm just more about stability. And two was really a lack of predictability. And so not knowing where my retirement account would be in a year, 5 years, 10 years, 20 years, that really bothered me. And so I started looking for different ways to invest, came across the concept of syndications, and with a focus of cash flow and kind of lower risk, more stabilized cash flow and syndications, that I thought that was going to be a really good fit for me. So I started to rotate my money out of stocks and bonds in early 2002 into syndications. And I did that for several years. I was in the corporate world, and I eventually got out of the corporate world thanks to the cash flow back in 2007. So I've been investing in this stuff for about 20, actually in February now. Yeah. So it's actually exactly 22 years, but I've been doing it full time since 2007. So what is that now? Almost 17 years.
Yeah, that's awesome. And I think going along those lines, I feel like syndications, I don't know if it's because of the pandemic, but I've seen just a ton of new syndicators coming into the space and taking on additional capital. So for being investing into it, going on going back 17 years or getting that financial freedom from 17 years ago, that's pretty great. And I agree with you there. I was always just invested, 401k, IRA. And then I sat down, I was like, I don't know if I want to wait until I'm like 60 or whatever, 59 and a half to access those accounts. There's got to be a better way. And that's what, I know we were talking before the show. That's what led me to the Left Field Investors Group and that passive investing. And I was like, there's just gotta be a better way. And then it's like, oh, like I could actually invest in an asset where it's not tied to the stock market per se.
Yeah, and it's funny you mentioned that whole being trapped in that account. So keep in mind that you can do these types of investments through retirement accounts, and then you are still locked into that timeline. I purposely didn't actually do any of them through the retirement accounts so that I would have access to the cash flow if I needed it. And so that's the approach I've taken. It has the pros and cons. Obviously, if you invest in real estate, even passively, you get a lot of different tax advantages, like depreciation flow through, expense flow through, that type of thing. So that's very, very helpful. But I personally, just like you, I've not done anything on the retirement side, but I know a lot of people do.
Yeah, and I think that's super helpful for our audience too, because I know for me, I was looking at like a solo 401k, I was looking at like a self-directed IRA, and I haven't pulled the trigger. I just have my cash on hand. I keep it in a high yield savings account. When I'm ready for the next investment, I'll go put it in there. And like you mentioned, like a lot of that depreciation and what you get of it, you're not necessarily paying as much, as that ordinary income. But going along those lines, that I know I mentioned in your bio, full-time passive investor, what does that mean to you? Is that someone that now you have this financial freedom where, let's say hypothetically speaking, your bills are 5,000 a month, you have 5,000 a month in passive income coming through, or is it 10,000 a month? Or how does that, like, what is really that definition for you of a full-time passive investor?
Yeah, great question. Well, so when I left the corporate in 2007, the one thing that gave me comfort in leaving, because I'd never left the corporate, I was highly conservative. I spent over 10 years in the corporate. I worked for big companies. Like I was just going on the regular, corporate track. The last company I worked for was Toyota headquarters, and previous to that was Disney headquarters, right? And I have an MBA from the Wharton School, and so I was going down a whole corporate path. What gave me the comfort to do it is I had a 2 times cash flow coverage compared to my living expenses at the time. And my optimal target was always 3 times cost of living compared to income compared to living expenses. And if someone chooses to do it like where they're making 5,000 and then they're living and their expenses are 5,000, all I would caution you on is that things happen, right? And you don't always, things don't necessarily go as projected sometimes. And so I would recommend, I'm not a financial advisor or anything, so this is just my perspective as an investor, but I always recommend having a cushion for sure. So to me, the really comfortable cushion is like 2 to 1. The ultimate cushion is 3 to 1 if you can get there.
Yeah, and I think that's super helpful for our audience, and I would agree with that. I don't know if I'd be leaving my day job, even though it'd be nice to have the 5K coming in and the expenses being 5K, but you never know, is there going to be a capital call? Is there going to be a pause distributions like what we've seen the last, year or so? But with that said, when it comes to your passive investing, how have you vetted your sponsors? Is there certain, qualities you look for in them? Is it track record? What does that look like before, you really even really dig deep into their deals?
Yeah, I can't stress how important the sponsor is. I mean, I tell people that I kind of consider the sponsor to be slightly more important than the property, even with the property being a close second, because you are giving control to somebody else and you are just putting the literally the success of the opportunity in their hands, right? Because they have full control over it. And so I'm looking for someone who's conservative, who's looking to kind of under promise and over deliver as far as just a general mentality, and who will, essentially is very similar to my personality, actually, what it comes down to. And when I read, what I'm trying to avoid is someone who's over promising, using like flashy marketing materials with really big numbers, and then may underperform in the end. That's who I'm really trying to avoid, if you really want to break it down to that. I personally have a requirement to invest with someone who's experienced. And I try to avoid people who invest in many different asset classes. I'm talking about the sponsors. To me, I'd prefer to have someone focus on one asset class. If it's two, it might be okay, but that's probably the limit at which I'm comfortable with. And especially if they're complementary asset classes, that's a little bit easier. I obviously want to see a track record. It's very difficult to gauge a track record these days because there was so much momentum and with this record long cycle that if someone's been in business for 10 years, except for the past couple of years, they almost certainly made money unless something went really, really wrong. So it doesn't fully tell you how good of an operator they are. And right now, at this particular time, because we're recording at the beginning of 2024, very, very critical because it's a very tricky period right now. I'm trying to avoid people who have any distress. And I certainly want to make sure that no one's had a foreclosure, because what a lot of people don't realize, and I saw this in 2008, 9, 10, is that if you just have one foreclosure as a sponsor, your interest rate for years will be higher than if you didn't have that. And so as an investor, all other things being equal, if I invest in a deal with a higher interest rate, there's actually a lower return for the same amount of risk than the next person, right? So it's a very tricky time right now. You do not want to invest with someone who's got the stress and who may be distracted by that, and or who may be, dealing with other challenges because of that, investor lawsuits, etc. So it's a very, very challenging time when you're vetting the sponsors right now.
Yeah, and I think that's really excellent. And I would agree with you there. Before I even look at a deal, I'll check out the sponsor, talk to the sponsor, and then if I like what they have to say, and then I'll maybe start to go a little bit deeper into the deal. But it's something that you mentioned about, and something I found when talking to different sponsors is it's almost every single sponsor I talk to, they say our underwriting is conservative. And I think for like a new passive investor, for me, I just took it as, early on when I was passive investing, that sounds great. They must have done their due diligence. They are what they say. They say they are conservative. I think what I'm trying to get to is when someone says that to you, are there like certain benchmarks that you look at? Is it the deal itself where say, hey, they're actually underwriting this conservative? Or are they just saying that because 99.9% of sponsors are saying they underwrite conservatively?
Yeah, great question. So my whole philosophy in looking at an opportunity is trust but verify. What I mean by that is I'm going to take all the information the sponsor's giving me, trust that they did some due diligence, trust that they know what they're doing if they're experienced, but I have to verify. And one of the portions of verifying is verifying how conservative they've been. And so there's a few key things you can look at just to start off, like just as a starting point, that then you can dig in further. One would be an expense ratio on a property. So, I actually saw a deal recently. I think it was a retail deal. And, you know, let's say conservative typical expense ratio might be 40 to 45%. There's a lot of ifs that depends on the leases. Are they triple net? Are they gross? It depends on whether it's a cold weather area or not. There's a lot of factors. Okay. But I'm just giving you a generalization. And the expense ratio for this deal was like 20 or 25%. So honestly, based on my experience, I literally almost couldn't care why they would tell me that was the case. It just could not have been conservative. It's really not possible. So you have to look at key things like the expense ratios, the inflation assumptions for revenue and expenses, the assumptions for rent increases. You have to look at the exit cap rate assumption, what they're assuming they're going to sell for in the future. The vacancy and occupancy assumptions are absolutely key. And it's funny because a lot of these numbers I'm giving you are the ways that a sponsor can manipulate a pro forma to look better. In subtle ways as well. Then there's like a second layer you can go into looking at every single line item. But that's a good starting point.
Yeah, it's pretty crazy. I've seen probably the one I've seen manipulated the most, at least the deals I've been looking at, has definitely been the vacancy rate, where they're saying we're gonna have a 1% vacancy rate, so we're gonna
Oh,
get, and it bumps
you've
up.
seen that 1%?
Yeah, I've seen that,
Oh
and
God.
I've seen things where it's been like heavy value add, Class C property, 50% vacancy. Within 6 months, they're gonna turn around to 90% vacancy.
Oh yeah.
And then and when I say that, I'm like, okay, I'm not gonna, that's just
Wow.
up pure optimism. Yeah, it's crazy when some of these deals, and I think a lot of it has come from these newer syndicators that have come
Yeah.
up in the last, probably 2 or 3 years, but with going along those lines and talking about syndicators that are, maybe not the best to work with. I know you mentioned it in other podcasts, and I was actually doing it before I heard you on a podcast, but I was running background checks on sponsors, and I found it interesting, and I was curious, like the red flags that you look for when you're doing it. And the reason I say that is like one guy, he had a bunch of tax liens on
Yeah.
himself. So I was
Yeah.
like, nope, that's a red flag. But then another guy, he ran, 2 or 3 red lights over the course of like 5 years. So I'm like,
Right.
is that one that I'm, fine investing in? Or definitely the tax lien guy, I'm like, nope, that's too scary. But curious, like, are there, when you're running these background checks and like the red flags that you see, does it like, like that guy running the stoplight, or is it something else?
Great question. So, before you even get to that, one thing I'd strongly recommend is that you ask somebody before you run the background check, and each person you're running it on, before I run the check, is there anything I should know that you want to explain up
Mm.
front? Because I've seen instances. I remember very distinctly, like there was one person who had a gun in their trunk, and it was licensed to them, but they didn't realize they couldn't have it in their trunk in their car at the time, whatever it was. They told me in advance, right, that you're going to see that. But I've also seen the flip side where somebody had a bankruptcy. Okay, but it was more than 7 years old, and on your credit it gets removed, but on your background check it doesn't. They probably didn't know that. That bankruptcy like 10 years ago, and they said no, you're not going to find anything. And of course, there was a bankruptcy. And good lord, if they're forgetting about their bankruptcy 10 years ago, that's pretty unlikely. So that means they're hiding it, right? So that's you want to give them a chance to tell you, and then test them and see what happens. Now, going into the more detailed stuff you're talking about, because each scenario is different, right? So your tax liens, for example, you see them from time to time. But sometimes I'll see a tax lien from like 2004 for $240 and either was paid off the next year or it hasn't been paid off. And I literally say to them, I see a tax lien for 240. This is a person who has like millions of dollars of property, right? And I say, I see you have a tax lien 2004. Are you even aware of it? They're like, oh my God, I didn't know I had that. Give me the case number. Like that can happen because they moved that year and it didn't get to them. So each situation's different. Obviously, a much larger tax lien, even if it's older and they claim they didn't know about, that's going to be more concerning. Also, sometimes someone may have a tax lien, pay it off very quickly. So each scenario is different, right? So you're looking at liens, judgments, bankruptcies, criminal. To your point, speeding, is fine. Is speeding okay if they're getting caught I'm going to use an extreme example, but if they're getting caught speeding every 2 months for the last 20 years, there's something about their personality. And I don't know what that means, but it'd be something to think about, right? It's just something standing out. And so you really have to look at each individual and what you find for each one and think about it hard. But background checks to me are absolutely essential. They're a mandatory, and they've saved me multiple times for sure.
Yeah, it's excellent. And I couldn't agree more with just talking to the person about what I find too, have them explain themselves and see how they explain that, like in different background checks. Like I've noticed like different things and like, hey, what was going on? And a couple of times they said, hey, I was going through like a divorce. That's why this showed up. And I was like, okay, like, that makes
Yeah.
sense. Glad you could clarify it. But I'm glad I would ask them and to do that due diligence on the background. Um, yeah, continuing to talking about the different sponsors. When you've invested in a deal, what do you think like the adequate client communication should be? I have some folks that they will send a monthly report. Some of them send a quarterly report. I don't have a preference right now as long as I mean, I haven't had any distributions paused, So it's been very, very consistent. But curious on your end when it comes to like the how they handle communication, or how often, if you like reach out to them, how quickly should they get back to you on in that as well?
Yeah, great question. So on the reporting side, um, so what I've noticed is that as of about 2015, 16, when a lot of new sponsors came in, where there was a lot of money chasing these types of deals, some of the new ones ended up doing monthly reports, where all of the older ones were doing quarterly. And the thing that bothered me about monthly reports, actually, I like getting them, but the thing that bothered me about them is that I like to have a balance between what's fair to me as an investor and what's fair to the sponsor as well. I don't think it does anybody any good if they're overwhelmed, either because they have too big of a preferred return, they're not going to make any money, or if they're trying to report every month and trying to send checks every month, and it's very difficult operationally, right? So my take on it is that I'm totally fine doing quarterly. Do I like getting monthly? Yes, but honestly, monthly is almost a little concerning to me, because monthly is asking a lot when they're focused, especially if it's a larger operator that have a lot of properties. Um, so that's my take on that. I would caution everybody, though, please do yourself a favor. If you're looking at a new sponsor, don't make any assumptions about what's the content of that report is going to look like. Ask them for if you have to, redacted sample quarterly report. And just so you know what to expect, because there are way too many times where I hear someone complaining about a lack of information in a quarterly report because they didn't look at a quarterly report before, and now they don't like what they're getting, and they could have made a decision to pass because they wouldn't have been satisfied with what they were going to get, right? So that's on the investor, in my opinion. As far as communication, so a lot of the companies are different. Some of the larger ones have dedicated investor relations person. Some of them don't. I would say that if there is a problem with the deal, so if something, cash flow stop, whatever, it's fairly common, and I think probably necessary for a sponsor to report monthly, even if they normally report quarterly, to give monthly updates as to what's going on. I think that always helps a lot with helping investors understand what's going on. And then I've been in a deal a long time ago before where, and it was quarterly, went to monthly, and then once they got past the challenge, they went back to quarterly, which is totally reasonable. As far as response time goes, I mean, that's very subjective. Like in business, I would hope somebody responds to me within 3 business days. I'm very patient with that. I will only follow up with someone after 5 or 6 business days. So where I get annoyed is if I have to follow up with someone every second time I'm emailing them twice, or that type of thing. Then you start to question what's going on. But I want to point something out that I learned very early on in my investing career that a lot of people don't think about. I worked at Disney headquarters in 2002, and that's when I started investing. And I was used to having to create buttoned-up presentations to executives, and they had to be perfect, right? And they had to look perfect, and you were very careful with them. So when I started looking at deals, I would be attracted to the ones that looked really good and very polished, and I would kind of dismiss the ones that looked a little bit more amateur. But what I learned over the years is that I would much rather invest with the person with the worst documents with the best operations than the best documents with the worst operations. And I eventually shifted that thought, right? And I kind of feel the same, right? So someone who's communicating and responding immediately, that's a plus, but their operation, so you can have the worst communicator but the best operations, sometimes to the point where people don't want to invest with them again, but at least you're getting a good return and a good outcome as an investor, right? What you don't want is someone who's responding every 2 minutes and you're getting foreclosed on the property. Truly, right? I'd rather take the other. So please keep that in mind when you're trying to evaluate all this.
Yeah, I think that's excellent. I think something that I've done just to test out the communication style of a syndicator or an operator is when I send over a deal, I'll just go through it. I'll just ask them a question, and I want to see how long they get back to me. And usually, the majority of them get back to me. Like you mentioned, about 3 business days. On the rare occasion, I'll find one that gets back to me 2 weeks. I'll respond to them. They get back to me 2 weeks later, and
Oh,
then that's just like that. That's usually when that gives me a good, not a good feeling, but the feeling, okay, I'm just going to pass on this, because if I haven't even invested, say, 50K, 100K with you, and now your communication is delayed, what's going to happen once I give you that money? And then getting, not to say not a good deal, but definitely makes me leery of investing with them.
yeah, but so for those who are listening, what I really like about what you're doing is you're testing. Like what I love about what you're saying is you're testing, because most investors don't think to do that. Most investors don't think to ask for the quarterly report, and then they get surprised after the fact when they're not getting what they want, when they could have tested stuff, right? So to Trevor's point, do these tests and understand who you're going with, because one of the challenges and downsides with this type of investing is that as soon as you invest, your money is locked in, it's illiquid, and it's very difficult to exit out of that deal, and it could be for 10 or 15 years, right? So do as much due diligence and testing as possible upfront before moving forward.
Yeah, I don't think we can say say enough about having that due diligence up in front. But I want to talk about capital raisers, and it's something I had to learn as a passive investor. And I've seen a lot of them come up in the space where I think that this particular individual, I'm not singling out any particular capital raiser, but just capital raisers within themselves. I think that they're the ones that are promoting the deal. They're the ones finding the deal. But I find that a lot of these investment firms, they just have these capital raisers helping them out to, bring capital into the deal. I was curious what your take is on it because I've heard some good things about having these capital raisers, getting potentially better terms. And then I've heard bad things where the communication isn't as good because the person putting together the deal is talking through the capital raise and the capital raiser is talking to the people or the investors from there. Just curious what your take is on it because I'm hesitant to invest with the capital raiser, but I do know that there are some people that do like investing through them.
Yeah. So first thing is, I'm one person's opinion, but I personally don't invest through Capital Raiser, and the only reason is because I do this full time. So I'm able to network and find the sponsors directly, and that means I don't have to go through an intermediary who often is taking a portion of the profits or a spread and or some type of management fee. Right? So my return would be lower, possibly going through an intermediary. That's why I don't do it. That being said, first of all, I think that capital raisers can be helpful because they can get people access to deals they wouldn't normally have access to. They can get people minimum investment amounts they wouldn't have access to, and maybe even better terms they wouldn't have had access to, right? So there's some positives for sure. Um, that being said, like everything else in life, there's going to be good and bad of that type. And, one side of the spectrum is someone who's very thorough, who is being very careful and who's doing very low volume and being very, very careful what they send to their group. And the other side of the spectrum is someone who's trying to make as much money and isn't really doing any due diligence at all. And frankly, I have seen both, and I'm not exaggerating. I have seen people, I have been blown away. I mean, I have literally seen capital raisers who, after they were in the deal a year or two later, I'm discussing the deal because I'm invested in it myself through the sponsor, and they don't even know the loan terms.
Oh, wow.
I'm not exaggerating. And so to the point of what we are talking about before about doing your due diligence testing, if you're going to go through a group, you absolutely need to understand and determine how much due diligence they're really doing and get comfortable with them. And the truth is, if someone's really, really thorough, getting better terms, and you feel like they could do a better job than you of weeding the deal out, even though you're going to do it yourself as well, that could be a plus, right? Some people might want to go through a capital raiser for that. So there's a right place for them, and they are helpful for some people. I just don't like going through an intermediary myself. I'd be very, very careful. And by the way, and this applies to sponsors too right now, just because of current timing, be very, very careful about people who are launching new funds or new deals right now, because in some cases, some sponsors have deals that are failing or distressed. They're making no money off of them. They have 100 employees, 50 employees, and they have to keep the lights on. So they're launching a fund, even though they're dealing with that, and they're probably going to get some acquisition fees and other fees from those deals that they're raising money on right now, possibly to literally keep their employees there and their lights on. I'm not exaggerating. And so be very careful. That's what I was saying before. It's a very tricky landscape right now, and it could be happening with investor groups as well. That's why I mentioned it.
Yeah, I think that's excellent to keep in mind, and not to backtrack, but just something I was thinking about while we were talking about capital raises, but just the sponsors themselves. When it comes to investing in the deal, what should someone be looking for? How much skin in the game should the sponsor have? Because I don't like for me, I don't want to invest in the deal if the sponsor hasn't invested anything in the deal. Because what's the potential risk to them if the deal goes bad when it's my money being put. So just curious, like how when you're looking at a deal, what you're looking for the sponsor for them putting their own money into it.
Yeah. So I would say, as a general rule, I think it's more reasonable to expect a smaller sponsor to put more money in, and less reasonable to expect a bigger sponsor to put more money in or a lot of money in, which almost sounds counterintuitive because a bigger sponsor is probably going to be higher net worth, because a lot of the bigger sponsors, and I mean really big sponsors, don't have the bandwidth, like millions and millions of dollars. Like, so I invested with who is now a top 20 self-storage operator in the US, right? And they own 60, 70, 80 properties, whatever the number is. They are putting up earnest money every time in the millions. They have to have so much money liquid to be able to even just transact stuff, that if they can't do a co-invest on your one deal, it doesn't mean they're not involved in a deal. It just means literally they have millions of dollars put aside and forget about the operations costs and everything, just to be able to buy the properties, right? So everyone has a different opinion on this. I know that some people like to have, it's like a rule for them, they have to have skin in the game. That's actually not mandatory for me for the most experienced operators. But for the smaller operators or less experienced operators, absolutely. And I think that what's reasonable, typically the target would be 10% in my experience. I've seen as high as 20 or more, and you see sometimes 5%. And really, some of it has to do with someone's net worth. If they're relatively new, they may not have more than 5% to put in. So it's a tough question. It's very subjective, but I don't have a hard rule that like it has to be that case or I'm not going to invest with someone. It depends on their level of experience.
Yeah, I think it's just looking at like a case by case, like you mentioned, the smaller syndicator, probably putting that, excuse me, probably putting that money in versus the larger syndicator. Maybe not putting in, but they've done it in other deals, and obviously they have more net worth and whatnot. But something I want to touch on, they talked about before, was when it came to the capital raises, but the fund model, and something I've seen where you have like your single asset allocation. So let's say it's a multifamily apartment complex, and that's just the deal by itself. And then you might have a triple net lease fund where, say, it has 5 properties in it. Do you have any sort of preference versus a fund model versus a single asset allocation? Just curious to get your thoughts on that structure.
Yeah. So my personal preference is individual property for the most part. And that's just because I like to be able to analyze exactly what I'm investing in, right? Because often with a fund model, you're investing in a fully blind pool or a semi-blind pool where you can't analyze all the assets. Like when you give your money, it's not the last money that's going in. They're going to require more stuff in the future. That's a lot of trust, not knowing what it's necessarily going into. That being said, if I've invested with someone for a whole number of years and I have 100% confidence in them, to a degree, the fund model is interesting because then I get more diversified with them for the same amount of money, right? So it could depend, but on average, I prefer individual properties. And I've in all my conversations with investors over the years, I think on average people do prefer individual properties. I will say though that a lot of people don't realize that whether you're going to see individual properties or funds is actually cyclical. So at the end of a cycle, back in 2018 to 23, call it, there was a lot of funds and fewer individual deals because there was a lot of capital chasing deals. It's easier for a sponsor to execute on a fund and just pull money together and buy a bunch of properties and go one by one. And when they're in a driver's seat with the capital raising, that's typically what they choose. And so now that things are changing, you're going to see a lot more individual properties and less funds, both because the sponsors won't have the confidence they'll be able to raise the funds on a larger fund versus an individual property, but also because it's harder for them to raise capital in general. And they know that investors would prefer individual properties. They're going to have to cater to what investors want, right? So we are now seeing a reversion back to individual properties from the funds the past few years, and I expect more of that in the short term anyway.
Yeah, that definitely makes sense going forward into the future. And then talking along these assets as well, where you could have, sometimes I like to think of it, and I don't know if it's exact, but you have like your cash flow plays where it might be, again, like a triple net lease, very stable. Then you might get more of your, I don't know, say Class B multifamily, where you're coming in, maybe it's a value add, less distribution up front, more equity play on the back end. When it comes to these investments, is there a certain cash flow to equity that you're looking towards? Are you more on the cash flow slide? Just curious, because I find that's a hot topic whenever I'm talking to other passive investors, where either one's going for cash flow, one's going for equity, where it's kind of hard to potentially bridge those two worlds together.
Yeah, good question. So this is a very subjective topic. I tell people there's 1,000 ways to invest, and none of them are wrong. Some people only invest in land deals. I've never done one after all these deals, and so my personal profile is stabilized cash flow, 80 to 100% occupied. May or may not have any value at upside. I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I got into this for that predictability that we talked about before. That's been my focus the whole time. So for me, I have a strong preference for cash flow. When I'm analyzing a deal, I will sooner analyze the year one projected returns net to investors in terms of cash flow and the averaged annualized return projected net to investors on the cash flow. I look at that versus the IRR. I don't even pay that much attention to the IRR because I'm all about the cash flow. And so, of course, if a deal ends up lining up with certain cash flows, it ends up being in a certain IRR range typically. But the point is that that's my focus, whereas a lot of investors will focus more on the IRR and more on value add. Yeah, and I want to point something else out as well, so which most people don't realize, and it kills me. So what's fascinating is that at the end of a cycle, it's almost impossible for a sponsor to buy a stabilized deal and attract investors because cash flows are too low because the prices are too high. They're paying multiples that are too high. And so they have to pivot to higher and higher value add, which is actually how we got to the floating rate bridge loan problem, because that was actually became necessary to keep the cost of debt low enough to keep the projected returns high enough to attract investors. It's just like the progression until like it gets too expensive. So that is the riskiest time to do that type of deal because like an airplane on a runway, when you have the most amount of runway to take off at the beginning of a cycle, doing a value add deal is the least risky because you can course correct and then take off. At the end of a cycle, you have the least amount of runway left before it stops. And that's the riskiest time to do a value add deal. But ironically, that's when you will find the most amount of value add deals available. And that's what sponsors are trying to raise money for. So it's the opposite. So now with this timing, I mentioned is because of the specific timing, the cycle's resetting. It's actually lower risk to do value add at this point in time, technically speaking, maybe just after a recession and going forward for the next few years versus at the end of a cycle. So just keep that in mind. It's the opposite of what sponsors are providing for you.
Yeah, I think that's super helpful. And Jeremy, I just want to say I really enjoyed our time today. And one last question for you today is if our audience is looking to learn more about you, get in contact with you, how should they go about that?
Yeah, so I'm very low key. I have no website, no social media, no marketing or anything. So people are welcome to email me if there's any way I can help. It's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. And don't hesitate to reach out if there's any way I can help you.
Awesome. I'll make sure to include that in the show notes of today's episode. And again, Jeremy, thanks for coming on to the show.
Oh, no problem. Thank you for having me. Hopefully this was helpful for everyone who stayed with us here.